Well, good evening. Thank you for coming along to the first of my 6 lectures this year, called, rather embarrassingly, Conjectural Refutations. Let's see where that leads us. I'm not quite sure I fully understand what it means, but maybe between us all, over the 6 lectures, we'll get there. We're going to try with the next 2 lectures in November and February to hold them at lunchtime, giving you at least a chance to see me during daylight rather than in the midst of the British winter when it will be cold and wet. It may well be cold and wet at lunchtime as well, but at least there'll be some sunlight. So let's see how those go at lunchtime. I hope many of you can make it at lunchtime, who also make it in the evening. Today we're going to think about how macroeconomists have thought about the costs of business cycles. It's a very big research topic for economists, but also it's an issue of great interest to people everywhere. The very word business cycle, the words recession, the words interest rates, booms, are part of everyday language, and we use them sometimes carefully, sometimes carelessly. And it's a moment where we can use in this lecture, I think, a few minutes to try and think, what does a macroeconomist think about a business cycle? And as you may know, macroeconomists can really be cut up in 2 ways. Actually, many argue they should be cut into many more pieces than that. But the 2 cuts I have in mind are the short run and the long run. You'll remember that the long run is concerned with things like economic growth, secular trends in income, wealth distribution and demographics. And the short run is really what occupies us in today's lecture. It's the stuff of unemployment, inflation, boom, bust, and concentrated attention on when interest rates will rise. That's really all we really care about as macroeconomists, don't we? And ultimately, the short run is about temporary fluctuations in income about some long-run trend. These temporary fluctuations in income are what macroeconomists call business cycles, and they've been defined by many people as recurrent but not identical and persistent movements in output and other aggregate time series around a trend which is actually uncertain in real time. Business cycles, we know, are newsworthy and memorable. I pulled off some images yesterday. Many of you are too young to remember them, but it's immense how these resonated with me. I remember the times. Well, not the ones to the top left or the top right, I should say, but the others I remember. Actually, the ones at the top left and top right were ingrained into me when I did O-level history many years ago now. So I have some maybe false collective memory of even the Great Depression. But these images of recessions leading to losses of jobs persistently, enormous impacts on poor families, billions of dollars lost as stock markets crash, events that we are sadly familiar with, not only since the collapse of Lehman's, but also practically every day when bits of news come along, perhaps about car manufacturers lying about emissions tests, leading to changes in share prices. The collapse of Lehman Brothers 7 years ago, the exit from the ERM in 1992, Norman Lamont standing on the footsteps of the Treasury. I assume you can all recognise the man standing behind him to his right. Do you recognise him? No, there's Lamont at the front, but behind Lamont to his right. Exactly, young David. And those of us who remember the late 1970s and 80s with people just seemingly persistently unemployed for a very long time. So it would seem in terms of popular culture, that business cycle shocks are both newsworthy and highly memorable. And if I were to ask people in this room, even if business cycle shocks are temporary, fluctuations of 2 or 3% around a trend, and I asked you how costly are they, you would say they must be costly. People are losing their jobs, people are losing their livelihoods, people may be losing their homes. We remember events such as, or we've been told about events such as the high level of unemployment in the 1930s. I talked about that in my second lecture from last year on the Great Depression. The long-term unemployed in the 1970s that I've already discussed. The house price crash of 1990-92, which again is something etched in my mind and the impact it had on friends and family then. And the recurrent pain of the global financial crisis. And so your answer is that these costs must be high. And if the costs are high, it would logically follow that we'd be prepared to pay a very high premium in terms of consumption foregone today in order to avoid such costs. If a particular shock is going to be very costly, you'd be prepared in principle to pay a high amount of consumption foregone to avoid the effect of that shock. So imagine if consumption in this world is defined by your house. If you didn't want to lose your house, you may be able to pay a very high premium every year so that if something did happen to your house, it could be rebuilt. That's the kind of view that we might have casually about the costs of a business cycle. Let me go on. Business cycles have always been around. They have a long and honourable history in economics. Indeed, prior to the advent of our science, the Bible itself seemed clear, with Joseph telling the Pharaoh to expect 7 years of plenty and 7 lean years. And certainly since the collapse of Lehman Brothers in 2008, we've had those 7 lean years, I think. The serious study of business cycles can be perhaps traced to the work of the MBER in America by Burns and Mitchell on the US economy, but also a famous volume on the UK economy, produced in fact by US economists Gayer, Rostow and Schwartz, called The Growth and Fluctuation in the British Economy 1790 to 1850. But before I go on to that, I also want to discuss what a business cycle is and whether it's something we can eradicate. It's something I talked about in last year's lectures. And here's a quote from Paul Samuelson, Nobel Prize winner in 1970, arguing in 1998, when the next recession arrives, you will find written on its bottom, made in Washington. Well, he turned out to be right, didn't he? Just as was the case with the last one. This is not because the Fed is a sadist or an ignoramus, nor is it because the bedrooms in the White House are occupied by politicians eager to lose elections. Rather, it is like the fact that hospitals are where most people die. If the central bank and fiscal authorities did not step on the brakes of an over-exuberant economy now, they might well have to overdo that later. There is never a guarantee that intelligent and feasible policies can be discovered which will lead to perpetual soft landings at high unemployment and a steady price level. So let me be clear that like the below median poor, economic instability we have always with us. So Samuelson is arguing there that no matter what we do, even if we design the best policies we possibly can to offset shocks and try to keep the economy on trend, we will still have perturbations in the economy. We will still have business cycle fluctuations. And then the question to ask ourselves is, are these fluctuations efficient? Are they appropriate? Or are they ones that we'd be prepared to pay a premium to avoid, just like the fire that may destroy our house? Do we want to pay? And if we want to pay, how much would we be willing to pay? This is the question that we're posing in this evening's lecture, and I hope I'm going to provide an answer to you. You may not like the answer, and in fact, we may want to argue with the answer, but we'll use the answer and the arguments against it as a platform to launch our investigation for the remaining 5 lectures this year. So, what is a business cycle? Well, here's a drawing that I knocked up to try and explain what a business cycle is, and let's have a look and see if we can understand. As I've already said, the key point about a business cycle is that it represents a temporary deviation from the economy's normal trend. The line, I'll see if this does point, it does. This line going up here is our notion of the economy's trend. The UK, over the very long run, the economy tends to grow at about 2 to 2.25% a year, with some fluctuation. Now, we don't know that trend with certainty, and indeed there's an error about it. The error, as we go further back in time, may be smaller, ONS willing, so we may have a better idea of the trend the further we go back in time. But today, because of revisions and our inability to fully understand the state of the economy in real time, there's tremendous error about the trend. So we have a notion of trend and we have some error about it. What we can observe quarter to quarter is the level of output. The level of output is something, again, that is produced by the ONS and is going to fluctuate for the reasons that I'll discuss in this lecture around that trend. Now these data as well is subject to error and can be revised, but I didn't want to put another error band around that as well. Just imagine even the data that we have here has a very wide error band around it, because we don't get all the information about the economy at the same time. It arrives slowly from returns, questionnaires and surveys, and sometimes we have to update and recalibrate our view of the economy. So that's not certain either. But let us suppose that this economy is subject to shocks, whatever type of shocks there may be. There may be weather, there may be fiscal, there may be financial shocks, there may be taste shocks, there may be productivity shocks, there may be confidence shocks, there may be financial shocks. There's all kinds of things that we didn't know today that happen tomorrow that cause us to recalibrate our choices and will lead to a different level of income and output in the economy. That's the business cycle. And what we may see over time is that the economy may lie at some relatively low level relative to trend, and this will be a trough. And once we've hit that turning point, there'll be a period of positive growth until we reach a peak here. And this movement from trough to peak we term an expansion. And once we've hit a peak in business cycle activity, if there's a large negative shock or a sequence of negative shocks, or the economy is particularly vulnerable because it's carrying a high amount of debt and people find themselves unable to borrow or hit their borrowing constraints, or interest rates rise in such a manner as to reduce their level of disposable income because they've already inherited some debt, we may find the economy then contracts in a persistent manner. And this movement from peak to trough we'll call a contraction. And indeed, even after a trough, it's not always the case that the economy may grow quickly. It may grow slowly, hampered by excessive debt, financial restructuring, arguably. I'm sure I'm not describing anything that doesn't sound very familiar. You may get a world in which the economy recovers, but rather slowly, and people term this a growth recession. So what we're really doing is thinking about these fluctuations here, as we go from trough to peak and peak to trough and move around trend. And the trend we will mostly ignore in today's lecture. We'll say that'll take care of itself, that will be exogenous, that will be a result of the rate of growth of productivity, the extent to which we learn about the world in real time, and over the long run will determine the ultimate level of income per head. But fluctuations around it will be a result of shocks, will be a result of our understanding of those shocks, will be also a result of the policy response to those shocks, how effective the policy response is, and our limited understanding of those policy responses. All of those things come together to lead to the level of output that we observe in real time. Shocks, structure, policy, and people's responses to all of that. It gets very complicated very quickly. Now, so, having an idea of what a business cycle is, this temporary fluctuations of output from trend, let's see what a real business cycle looks like. And when I say real business cycle, for those of you in the know, I don't mean a real business cycle in the sense in which it's driven only by productivity and real effects, such as tastes. I just mean an actual measure of the business cycle. And this is a chart from Georg Rostow Schwarz, published in 1953. The work was mostly done in the 1930s. Publication was delayed by World War II. And Anna Schwarz, who then subsequently collaborated with Milton Friedman on their famous monetary history of the United States, worked on this project as well. And what they were able to do is, from series of prices at financial markets, exchanges, from the prices of cotton, imports and trade numbers, they were able to construct a measure of index of business activity that ultimately found its way into measures of annual output that we have in the UK going back over this period, to provide us with a measure of business cycle activity. Actually, you can get it at monthly frequency from their series. It's quite a remarkable piece of scholarship that we're guilty of forgetting and not looking at in the degree that we should. But here I'm showing the annual numbers. And you can see a little bit like the trend we had before, and what I described to you heuristically, we have this upward trend and we have deviations around it. So if we were to extract the trend, which we think of as a statistical process, there are an infinite number of ways to extract a trend, but let's suppose it's been done. It could be a straight line, it could be a growth rate, it could be exponential, it could be many, many ways of providing that trend. But let's suppose it's been done. Just take away the trend that I described earlier on. Once we've taken away the trend, we're then left with this business cycle. 1790 to 1850, and we can pick some interesting periods. 1815, we see a relative low in the business cycle. 200 years ago, Waterloo, of course. So, and we can see that compared to today, it looks like the business cycle, of course, this is a war period from the 1790s through to 1815, seems to be very short duration of business cycles with relatively large amplitude in their fluctuation. But year to year, we don't really know where the business cycle is going to be. It's not that slow process that I drew schematically in the previous chart. But this is telling you something about what was going on in the economy at this time. And it tells you that people such as Geir Rostow Schwartz and others have been interested in trying to understand business cycle phenomena as economists in the modern era, in the middle part of the 20th century. More generally, we can, with the long-run data that we have in the UK, we can go back to at least 1871 and measure a whole raft of business cycles and understand their typical length. And this is in months. So you can see the typical length of a business cycle, either from peak to peak or trough to trough, is around 5 years. As always in economics, there's a standard error about that of around just over 2 years. So really, business cycles up till the end of the 20th century typically seem to last 5 years, plus or minus 2 years, between 3 and 7 years. And again, typically in economics, as soon as we established that stylized fact, we went away and had the longest expansion we'd ever had in history, 1993 to 2007, followed by the longest sort of period of a growth recession we've also seen. So we can kind of throw that chart away. Thank you very much. That was a year of research that I shouldn't have bothered with, but there we go. So how do we deal with the fact that there are business cycle shocks, there's a structure of the economy, there are policy responses, and all of these are leading to income fluctuating around trend? What are we doing as consumers? Well, economists think that what people are really interested in is the level of consumption they can have. And they take the view that what really matters for consumption is permanent income. So if the business cycle fluctuations are strictly temporary, they don't affect permanent income. And so what consumers will do is save if income is temporarily high and dissave if income is temporarily low, allowing them, as far as possible, to maintain the same level of consumption in response to those shocks. It's a kind of view that we'd have. And I'll go a little bit further into the detail of why we think people want to smooth their consumption. By smoothing their consumption, I simply mean try as far as possible to keep consumption as close to that trend that I described early on as they can. That's what I mean by consumption smoothing. And again, let's just look at the stylized fact rather than anything else. The dotted line here is annual UK output. The darker bars are recessions. And this is just showing the same period, 1871 through to 1997, showing periods of above and below growth, an idea of when we're above, at this point, here we're at a peak, here we're at a peak, and here we're at a trough, and otherwise. Sorry, that's the dotted line is output. Forgive me. Dotted line is output. The solid line is consumption. Now, you can see perhaps most clearly in the 20th century and beyond, but even earlier, is that the solid line, which is consumption, that's when people are treating the deviations as permanent to some extent and increasing their consumption a little bit because they feel a bit wealthier. Consumption is nothing more than consuming the current value of wealth, as economists think about things. But in general, we can see that the solid consumption line fluctuates less than the output line. So what people seem to be doing, even over the very long run, is that no matter how volatile the output shocks are, whether they're caused by weather or wars or productivity shocks or financial shocks, driving output up to 5%, in some cases 10% away from trend, consumption doesn't tend to do anything like that. And in fact, the actual numbers suggests that consumption, although it moves somewhat with output, is about 50% less variable. Again, suggesting that people are extracting or filtering the noise from output year to year and saying about half of it is noise, I'm therefore going to save or dissave in the manner that I just described, and about half of it is stuff I'm going to treat as permanent. So I'll allow my consumption to go up with the business cycle a little bit and down with the business cycle a little bit, but not as much as the business cycle itself. And if people are able to do that, what they're doing in effect is mitigating the costs of the business cycle. If their consumption moved one for one with output, the business cycle itself would have been more costly because consumption would have ended up being more variable. If, on the other hand, they're able to smooth their consumption, they're already offsetting a large part of business cycle costs. Again, I will explain this more as we go along. The result actually follows as well. For the US, we can do a similar exercise with the US data from around 1930, and we can see that the blue line here is consumption, and the red line is output, the so-called business cycle. Again, the bars are recessions. We can see again that it's about half as variable. Consumption is around half as variable as output, meaning that even if these business cycle shocks are causing output to fluctuate by 5 to 6%, consumption, the thing that matters to us, is half as variable. So we're able to smooth a large amount of these shocks. Now, why we're able to smooth is a question I shall come on to. Excuse me, I'll take a drink of water. Now, let me finally, before moving on to explaining some of the deep issues about how we measure the costs of business cycles, just give you a picture of the more recent 60-year period for the UK with what I've described rather catchily, I think, as a non-unique trend cycle decomposition. I don't think if I gave that as the title of my lecture, any of you would have turned up today. But this is mostly what we're doing. So we have a long-run trend in output, which I've identified as a red line. This identification is non-unique because there's lots of ways of doing it. And any trend that I found here, for example, with data up to that point, when I extend the data set, is itself variable. So what I mean by that is, if I take this out of the sample and estimate the trend, this red line would not have fallen, it would carry on with the trend. So actually, working out the trend is very hard in real time. It's not very stable. But if we accept this as the trend, we then get notions of business cycle variability. We get notice that even if we felt very badly off in the last 5 or 6 years, in terms of the variance of the business cycle, it doesn't look anything like as bad as the 1970s, or the long 1970s, which I would start at some time around 1972-3 and end in about 1982-3, something like that. Significantly more variation in output at that time, some 40 years ago, than there has been even over what we've called the global financial crisis. It tells you something about our attitude to things is often formed by the stability that went before it. But this very long period of stability here, what happened in the last 5 or 6 years seemed very bad, but it just wasn't anything like as variable as we saw 40 years ago. Again, that's something I discussed in a lecture last year that you may want to look at. You see the extent of the Lawson boom. I heard him on the radio this morning, so I thought I'd put him in my lecture. And we can see the point of the pre-global financial crisis peak here, 2007-8, just before Lehman Brothers collapsed, and this period of the global financial crisis with this large fall and this steady, what we might call growth recession that's followed, with output just about now coming back to trend all those years on. So we continue to have business cycle-like behavior. This is output, this is income. What we now need to understand is, what does that then mean for consumption? What does it mean for our notions of welfare? Well, before we can think about welfare, we need to understand what welfare is and how economists understand it. So let me spend a few minutes trying to explore some ideas such as risk neutrality, risk aversion, and how we're going to think about the calculation of the welfare costs of business cycles. So just bear with me. Two axes here. One is the level of consumption on this axis, and the other here is the standard deviation of consumption. Now, if I were a risk-neutral individual, whatever the standard deviation of consumption was, it wouldn't affect my level of utility. It would be the same. All that would matter is the mean level of consumption that I have. So anywhere along this point, if I was risk-neutral, would imply the same level of utility, because variance doesn't matter to me. I'm risk-neutral. If I'm risk-neutral, I don't want to pay off if I'm bearing risk, and I don't want to pay any money to offset risk. Risk doesn't matter. It doesn't enter into my calculations of normal life. That's what we mean by risk-neutral. So in this world, the indifference curve of the consumer, all points here imply the same level of utility, would be flat with respect to the standard deviation of consumption. Just take that as a first proposition. Now, let's imagine that we're risk averse. Now, what does risk averse mean? Well, again, this is an indifference curve here. Now, if we take this point here, at this point here, we're at a given level of consumption here, and we have a given level of risk here. If the level of risk is the same, but the level of consumption is higher, then it must be that this indifference curve implies a higher level of welfare than this indifference curve. So as we move this way, which is northwest, we're going to end up on higher levels of indifference curves. But let's not worry about that for the moment. We're just going to say that there's a family of indifference curves all plotting the same level of utility. Now let's try to understand the slope. Now if I'm at some point here, which implies this level of consumption and this level of risk, what this slope is telling me is it's telling me if I have to bear more risk in consumption, this is how much more consumption I require to have the same level of utility. So I'm indifferent between this point here and this point here. So it's just a proposition I'm suggesting to you that if I don't like risk, I'm risk averse, then there's two ways to think about it. Either in order to accept a level of risk and be indifferent to it, I'm going to require compensation in terms of having a higher level of consumption. So my curve looks like that. Or alternatively, if I have a high level of risk here, I'm going to be indifferent. That means I'm prepared to give up this much consumption if at the same time I can eliminate this amount of risk. I'm not going to care whether I'm on this point or this point. If I'm at some point here, I'm less well off because I've given up some consumption, but I haven't reduced my risk. And so I want us to think of a world in which consumers, when they're deciding upon their consumption plan, have deep in their minds a notion that they want to trade off some consumption for some variance. And that if they're going to accept more risk, what they're going to want is a higher level of consumption. Or alternatively, they'd be prepared to give up some consumption in order to reduce the variance of consumption. And it's this key insight that we have to use to think about the costs of business cycles. So what we need to measure is how steep is this line, which tells us how risk averse they are, and how much business cycle risk are they going to be getting rid of. If we can answer these two questions, I can tell you what the cost of a business cycle is. That's what I want to do. Let me go further. Let me go through this point again and use a different type of chart. And hopefully, at the end, before I go there, I'm going to explain other ways of sharing risk. So, let's take it as given that our agents like to consume, but they don't like variance in consumption. So they have some trade-off in their mind. There are various ways that these agents who don't like variance in consumption may be able to lay off their risk. Let's imagine the following world. Let's suppose we get manna from heaven. And let's suppose there are households here, household 1. And sometimes they get a lot, sometimes they get a little. Sometimes they get a little, and sometimes they get a lot. Now, if this household is not able to share its risk, this household is sometimes going to be hungry, and sometimes very full. Sometimes hungry, sometimes very full. It's going to have a lot of variation in its consumption. Because what determines its consumption is its endowment, or the amount of manna that drops out of the sky, which is going to be stochastic. They don't know period to period what's going to come, but whatever comes they eat. And as a result, their consumption is highly variable. Now, let us suppose there's another household, call them household 2, whose manna drops, as it were, are negatively correlated with theirs. So that when they don't get very much manna, this household gets a lot of manna. And that when household 1 gets manna, household 2 doesn't get a lot of manna. And now you can understand the contract that they may want to write. If household 1 and 2 could match up, they could write a contract with each other which says that when household 1 gets more manna than the average, it will donate this to household 2, and vice versa. When household 2 gets more manna than household 1, that's greater than the average, it will donate that to household 1. If they could write such a contract, it was credible and enforceable, then both households would always consume at the average of the level of manna that had been dropped, without any variance in the household consumption. They would then both be better off. All the manna would be eaten in every period, and households would not revert period to period from being poor to being rich, or from being hungry to being overfull. If they could risk share, and this is the key word, intratemporally, within period. If you could write such contracts, you could get rid of a lot of consumption variance. And from the previous slide, we know that people don't like consumption variance. So if we can write these kinds of contracts, even if there's a lot of stochastic volatility in the business cycle, we can reduce the average consumption variance for the average household by writing these kinds of contracts. Now, you might say, I don't write these kinds of contracts. Actually, you might. Through insurance companies, through pension funds, through arrangements through your firms, these kinds of contracts may, to some extent, be out there. We'll try and understand to what extent when we run our calculation in a minute or two. Now, how else might we smooth our consumption? Well, let us get rid of the intratemporal issue and now just think intertemporally. Now, let us suppose that my manna drop is going to be low and then high and then low and then high. Well, if I could borrow from the future of when my manna was going to be high, say I could put some of it in storage or someone else had put it in storage, if I can take from the future and bring it to the present in every period when my current endowment is low, or the amount of manna that I've had given to me is low, I can then always consume near the average. So even if the business cycle shocks lead to income being very low or very high, if I can consume from the future on the basis that I will have higher income in the future, I can ensure that my consumption path stays nearer to the trend than the income fluctuation itself would suggest. And this is intertemporal risk sharing, so through time rather than across agents. And again, through savings behaviour, we may well be doing much more of that through the financial institutions than we might originally think when we come into a lecture such as this. So again, we want to understand, if consumption is only half as variable as output, could it be these kinds of risk sharing that are going on that's causing the level of risk in consumption to be lower than we might expect, given the business cycle variance and the amount of time we spend talking about business cycle risk as a society? Now, let me illustrate with a graph size of the risk premium. So we have these ideas. First, we like the level of consumption. We don't like variance in consumption. Agreed. We also think that it seems that a significant fraction of business cycle risk is being smoothed by consumers. either through intratemporal risk sharing or intertemporal risk sharing. Now, into this problem, let me inject some uncertainty and try to work out what the risk premium is, because that risk premium is our calculation of the cost of business cycles. So please bear with me while I go through this. What we need first is a mapping from a given level of consumption, let's call it £100, to a utility function. Something that defines the welfare we get from £100 of consumption in terms of means and variances. I said that earlier on. What matters to us is utility, and utility is going to be defined in terms of means and variances. Now, if there's no variance, let's suppose we buy a government bond of a country that will definitely pay me £100 without fail. So let's call it a UK government bond, a country that doesn't typically default. Political correctness prevents me from suggesting names of countries that might default. Just take a step forward. Now, if I've bought a bond and the payoff is going to be £100 with certainty, then the consumption I'll get will be £100 and the utility will be given by this function. Let me just make a small point about this function. You can see utility is increasing in the level of consumption, but at a decreasing rate. The decreasing rate is important in a minute or two. We'll just get there. But it's positive, but at a decreasing rate. So the first derivative is positive, the second derivative is negative. And that matters for the variance calculation I'll come to in about 5 minutes' time. So if I get my £100 from the UK government, from a govy that I have, with certainty, my level of utility is UCA. Now, let's imagine that I'm going to get £100 in expectation, but with a 50% chance I'm going to get £50, and with a 50% chance I'm going to get £150. Obviously, the expected value of that is still £100. But what I've introduced now is some uncertainty. I don't exactly know whether today I'm going to get 50 or 150. I expect 150 because 50% of 50 plus 50% of 150 delivers me back to £100. But I don't know exactly what I'm going to get. And this is what we mean by risk. There are nebulous ideas about uncertainty, going around 19 uncertainty, or the uncertainty of life. There's so many things we don't know the answer to. Unknowable, unknown things about which we don't know. Fine. Let's leave them for the philosophy lecturer. Don't know about that. But the exact risk I want to measure here is what is the cost to me of the risk of not knowing whether I'm going to get £50 or £150 from this bond today. That's what we want to understand. So, if I get £50, my utility is going to be here. If I get £150, my utility is going to be here. My expected utility from this and this is therefore the midpoint of a straight line drawn between these two here. And you can see that that midpoint here delivers a utility level in the space of this function below the certainty equivalent level of utility. I'll just do that one more time so everyone can see that. If I get £50, my level of utility is going to be here, off this function. If I get £150, my level of utility will be up here. The midpoint of these two lines then tells me what the level of utility is I will get from this uncertain payoff. This level of utility here, which is uncertain, corresponds to a certain level of utility that actually corresponds to an expected return that's less than £100. Now, I haven't put the number in here, but let's suppose it's £90. So what we can see is because we're not sure about the return, the certainty equivalent value of this expected payoff of 100 is more like £90 than £100. This difference is a risk premium, 90 of £10. So what it means is that this, because we don't know what the payoff is, this £100 payoff in expectation is only worth £90, for example, to this particular person, and given their risk profile, which means that they'd be prepared to pay £10 to get £90 definitely, rather than accept the possibility of getting 150 or £50. Because the £90 gives them the same level of utility as the uncertain return of £100. This wedge is the risk premium. This wedge, if we can calculate it, is the cost of the business cycle. How are we going to get the cost of the business cycle? Well, we have to calculate the expected level of consumption, and we have to calculate the variance in consumption. We also have to take a view on the level of risk aversion, which depends upon the curvature of this utility function. But once we've done all of that, we then have got the risk premium. Nearly there. Can I keep your attention for a few more minutes? Exciting, isn't it? I'm glad you think so. Okay. What happens if the uncertainty is greater? The expected return is the same, still 100. But I've just cranked the numbers down so that, I'm sorry, there it is. It's not the clicker I use every day, so that's my excuse and I'm sticking to it. Now, what we're doing now is saying, well, look, I'll keep the expected return at 100, but I'll increase the uncertainty. This is going to be some number much less than £50, and this is going to be some number much greater than £150. But the expected, the midpoint is still 100. And if I increase the uncertainty and I run the same exercise, so this is the utility I get from this number below £50, this is the utility I get from some number greater than £150, and I take the midpoint, I can see here that the expected utility from the gamble is now even lower than it was when the gamble was less large. And now the risk premium I'm prepared to pay is even larger. I've got the same risk profile, I haven't changed the chart. All I've done is expanded the amount of uncertainty. So the risk premium we can see is a function of your attitude to risk, how much do you dislike variance, times the amount of risk. The amount of uncertainty you face with an uncertain payoff. The larger both of those are, the larger is the risk premium here. Now, we've done it in graphs, and this is in no way as difficult as it seems, but it's just an expression that we'll get to in a minute, and we'll have our answer. In fact, you see the answer at the bottom. The utility function, I'll go back one slide, I've aligned, it looks like this, can be described pretty nicely by a function such as this, where this row determines the curvature of that line. That's all you need to think about, the curvature of that line. And so the expected utility is a function of the average level of utility, that's this, C tilde here is just the average level of consumption, minus a term in the variance of consumption. We've already seen this in the line that I showed you a few minutes ago. It's just the average minus a term in the variance. We like the average minus because we don't like the variance. That's all we're doing. Forget about all the other squiggles. We've just got an average and a variance. To get to this number, we're actually taking the second derivative of this expression that gives us this, pre-multiplying it by 1 over 2 and multiply it by the variance. The second derivative is negative. Remember I said it's increasing at a decreasing rate. So this is negative here. And then we have here the cost of business cycles. Because if it could drive this to 0, this variance, there'd be no cost of business cycles. That's what we're trying to do. Here's our mean, and here's our cost of business cycles. So we have our cost of business cycles is some term in the risk aversion, some term in consumption, times the variance of consumption. To make it a sensible number, we'll divide by the marge utility in consumption, and then by the average level of consumption. So this expression is simply saying that the cost of business cycles is a term in the curvature of the utility function in the variance of consumption over the mean level of consumption. That's the answer. So just as I said a minute ago with the graph, and I'll go back, if it works. There we go. The cost of the business cycle, the risk premium, is a function of the average level of consumption and the variance of the consumption endowments times the curvature of the utility function. I said that graphically and verbally. Actually, mathematically, it's the same expression. So if we've got that expression, we can just plug some numbers in. The highest coefficient of risk aversion that people get, the curvature, is a number governed by 4. The coefficient of variation of consumption over the average level of consumption is around 3%. And so if we multiply this out, what we get is a number that says that the cost of business cycles is 0.2% of the average level of consumption. It's tiny. It's tiny because consumption variance isn't very large. There seems to be a lot of risk sharing on average. So let me put that into practical numbers for you. In the UK, if we transfer it into constant dollars, average consumption per head is around $30,000. And if we take 0.2% of that, cost of business cycles is only around $30 to $50 a year. Absolutely tiny, which is significantly less than the car insurance I had to pay this morning. Which seems odd. How does that work? That's because, of course, car insurance is idiosyncratic risk that I bear because I'm a very bad driver, whereas business cycle risk is something I'm able to share with lots of other people, and that allows it to be laid off in a particular form. But whether it leads to such a small number is a question of great controversy. So, as all good economists, I'm now going to tell you why this calculation is wrong, even though I've spent a lot of time explaining it to you. And there are a number of arguments as to why it's wrong. Whether we look at the US or the UK, the standard deviation of consumption by household or by head is only around 2 to 3% per year. The first thing to think about is I've been talking in terms of the average or median household. Is that an appropriate unit of account? Can we summarize economic activity with a representative household? Let me illustrate with an example. How about high or low income groups? Now, of course, if you're lucky enough to be in a high income group, you're going to have potentially substantial amounts of assets, human capital, collateralizable wealth, forms of lending available to you on tap, liquidity, in other words, that are going to allow you to hedge business cycle risks and maintain a constant level of consumption. If, on the other hand, you're unfortunate enough to be in a low-income group, you may have the kind of skill set that is vulnerable to a business cycle shock. You may be more likely to suffer unemployment. You may lose your home. And importantly, you may hit your borrowing constraint, may not find that banks are willing to lend to you in the same way as that high-income household. And if they're not willing to lend in a world in which your income is low, your consumption may have to move a lot. If that's the case, it could be that looking at the median doesn't deal with the business cycle risks that are suffered by lower income cohorts. And the people who've done this kind of work suggest that once you concentrate on those lower income cohorts who hit the financial buffers in a business cycle, the costs of business cycle they face are 2 to 5 to 7% of their consumption, not some small fraction of consumption. It gets considerably larger very quickly. And of course, if you're paying 5 or 6 or 7% of your consumption when your income is low, the marginal utility of that consumption is very high. It's very costly for those people. £1 to someone who's got £10 is a lot of money. £1 to someone who's got £1 million is not a lot of money. So these calculations may be faulty because we concentrate on the median. Another argument is that it could very well be that in the absence of stabilising monetary and fiscal policy, which was very much the subject of last year's lectures, and other institutional devices, business cycle variability might well have translated into considerably more consumption variability. So might we see more consumption variability in developing countries or poorer countries where these institutions haven't developed to the same extent? And people have done work there trying to examine this, but they're still not tending to get a number much above 1% of consumption if they take into account the effect of good or bad monetary and fiscal policy in institutions. What about using the standard deviation of the average? Is it accurate? Now, it turns out it's not necessarily accurate, because if we're looking at the standard deviations of all the average household bits of consumption over time, we're not then dealing with the average of the variation of every individual household. And I'll explain that in a minute with the next chart. So we don't just take a point in time every year and then look at the dispersion. We also have to think that every household has a certain amount of variance in its own consumption. And we have to look at the average of that as well and add it to the variance of the dispersion of the median. And finally, I've spent this lecture telling you that the business cycle is separate from the trend. But what if the cycle affects the trend? What if the cycle has permanent effects? If it has permanent effects on activity, it will affect the median household in a permanent way, and then our calculations have to be rethought because they affect the mean as well as just the variance. But even if they don't matter for the median, it could very well be the case that for certain households, business cycle shocks have a hysteresis. If I lose my job, I may stay unemployed for a very long time. It may have a permanent effect on my income, and so my level of consumption may fall, and that would mean the business cycle shocks. The costs are much larger than this calculation would suggest. My penultimate point about checking the variance of individual medians as well as the average variance of all households, we can begin to understand by looking at this chart. Here are just the consumption draws for the UK over the last 17 years or so. And you can see that it could very well be the case that there are different distributions here. And if I calculate the variance without looking at the different distributions, all I'm doing is looking at the mean, which in this case is about 0.6%, calculating the variance and putting that into my business cycle calculation. But for every household, there is a variance. Not every household will have the same level of consumption every period. Every household may have its own consumption going up or down. So we have to add that average variance into the calculation. So most measures of business cycle risk look at the variance of the average, but what they tend to miss is the average variance of all households, which would tend to increase this number by quite a large amount. In conclusion today, it's very clear that economists worry about business cycle. In fact, it's very clear that we all worry as a society about business cycles. I think the classic case would be William Beveridge's very famous 1944 call for full employment after his report on welfare. I haven't done this, but you could do it when you get home. The incidence of words in a Google search of recession, boom, bust are terribly common in our language. Clearly, these business cycle fluctuations occupy our thoughts in tremendously persistent and important manners. Dinner parties are rife with conversations of these matters, so they matter a lot. The calculation I've suggested suggests that actually these costs have already been eliminated, that the median household at least doesn't seem to suffer much variance and would not be prepared to pay very much more than a return trip to Cambridge, for example, to offset the costs of a business cycle. Now, one argument is that we don't want to pay twice for insurance. We may have already paid through taxes, fiscal policy, through our pensions, and through the adoption of an independent central bank for others to carry out this insurance for us in aggregate. So we don't want to pay again. That could be one argument. It could also be the case that when we look at the median, we don't understand fully the risks faced by certain households for whom the risk premium is not affordable and an important fraction of their income. Ultimately, these costs may look too low because we don't fully understand our deep preferences about risk. It could be that when we do these calculations, I assume that we all think we're at the median or average. It could be that we all think we're exceptional. Those of us who buy lottery tickets where the expected payoff is negative may buy them because we really think we're going to win. It could be that we tend to think in terms of the worst possibly happening to us and the best possibly happening to us in a way that doesn't chime with rational expectation. And that would require us to think quite hard about the utility functions, or the way that we map from different levels of consumption to our notions of utility. I'd like to thank you for coming this evening. I have a time for one or two questions before I have to go. Thank you very much.